Hi, the Casino Food Co-op. My name's Travis Bailey, Senior Financial Planner from Advice First. And thank you for joining us today for the annual superannuation webinar. We're the servicing advisors for the Casino Food Co-op or Northern Co-op Meat Company. And we welcome you today to go ahead and receive some education and some updates in relation to superannuation in general, and also more specifically the features and benefits of the Northern Co-op Meat Company Staff Super Fund with AMP. I'll just share my screen and we'll take you through the presentation. So today is of a general nature as well. So any information that we talk about, it's also important to consider your own personal circumstances. This presentation doesn't take into account your personal circumstances. So in the invitation to this webinar today, in the communication, there was an opportunity for you to reach out to us to go ahead and book a one-on-one. You can contact Kim, my assistant, or also click on the QR code to go ahead and reach out to us and make an appointment. But today is just of a general nature. Today's agenda will take you through who Advice First are, if you haven't heard about us before. We'll talk about get you thinking about your retirement, and also, are you on track for a comfortable retirement as well? How to grow your super through concessional or non-concessional contributions, and also some features and benefits in relation to getting the most out of your superannuation as well. And then there'll be some additional tools in relation for you to obviously gain more financial literacy and learnings in relation to your super, and also how to contact ourselves. So who are we? Advice First, we're a privately owned financial planning firm. We've been providing financial advice and education and support to Northern Co-op and their employees for more than 10 years. We specialise in advice and education, and we've been around for about 41 years in total. We're Gold Coast based, one of the largest financial planning firms in Queensland, and we service private, commercial, corporate, being Northern Co-op, clients both nationally and on an international level as well. We have 9 qualified practitioners where we specialise in all different sectors of financial planning advice and home lending. So if you ever do reach out to us, it is a service available to you that we can go ahead and align you to an advisor that we think is got the skill set and obviously the education and the training to best meet your needs, depending on what that is. We're also supported by our incredible administration team as well, who help us go ahead and stay in touch with our clients to help them through their financial planning journey. We also provide objective advice, and look, we're proud to say that we've got a 95% retention rate of private clients, which means that it's equally as important to us than it is to you to ensure that we are there to pivot, to go ahead and make any changes and provide solutions and strategies throughout your working and through your lifestyle now, and also through retirement as well. So let's get you thinking about retirement. The open-ended question we get is, how much is enough in retirement? What is that lump sum that you need to accumulate in retirement to be able to then draw down as an income stream for when you decide to stop work? And look, the amount that you need for retirement depends on 3 things that we usually look at. It's how would you want to live? That's obviously determined on, what your lifestyle looks like, and also what expenditure would be required to go ahead and meet those lifestyle needs. We also look at how long you will live as well. There's a demographic shift, which means we are living longer, and I've got some statistics in relation to that. But obviously, depending on how long we're going to live, will then obviously determine how much we need as well. And look, many of us are going to make it into our 80s or also our 90s. So that's a long time that we need to provide for our retirement. And then thirdly, where you live as well, depending on your surroundings, your environment, and obviously what your lifestyle looks based on where you live will then help you determine roughly how much you need in retirement as well. So let's move on. There's a number of different simulators that are out there in the market for you to be able to calculate what you are required to save for retirement to go ahead and support your lifestyle in retirement. I've provided here two calculators that are used. One's provided through AMP. It's called the AMP My Super Simulator. And at the bottom, there's the link there for you to access to actually play around and obviously simulate your own retirement and accumulation numbers. And then also you've got on the right-hand side, this is through Money Smart. It's a superannuation calculator, which helps you plug in the numbers based on your age, what your income is, when you're looking at retirement, and what your current super balance is, and how much is being contributed to that through either your employer or through you personally. And then that'll go ahead and illustrate exactly where your super is going to land. The AMP simulator also projects what income you're going to be able to derive from the lump sum from when obviously you get to your retirement age. So just a couple of little simulators for you to help engage, for you to get a bit of an understanding and idea as to where you're going to land when you decide to obviously retire. And then obviously what gaps are required to go ahead and fulfill your retirement needs between now and obviously your retirement age. So let's look at some retirement goals. I guess when we look at saving for retirement, some people save through maybe purchasing an investment property. They may have a savings plan going into maybe some bank savings or even into, say, a share portfolio. But one of the things that is guaranteed is obviously your superannuation. It is legislation that your employer must contribute 10.5% of your gross income into your superannuation, and that's going to build this retirement nest egg. Your money's invested into a portfolio, which I'll talk about, and then you have the option of whether you want to go ahead and make additional contributions into your super to help boost that retirement nest egg. And then by the time you get to retirement, you have accumulated a large sum of money. You then get to draw down on that sum of money that's going to go ahead and provide you with a form of income. Now, with that, when you do retire, the age pension age at the moment is age 67. So that's when you're able to approach Centrelink and apply for the age pension. So based on what you're drawing out of your super and what comes in from the age pension, if you're eligible, is that going to be enough to go ahead and sustain your lifestyle in retirement? So based on that, there's a lot of what ifs and a lot of assumptions. You can always reach out to ourselves. We are specialised advisors that are experts in this field to help with obviously that journey and to help you with the engagement and for obviously the education and understanding of how this works and how you are going to land. The thing is that we need to plan a lot more when it comes to our retirement because we are living longer and we are in retirement for a lot longer than what we were, say, over 100 years ago. This slide shows you that, back in 1909, the age pension age for males was age 65. So a lot of people, the superannuation wasn't around at that stage. So, and people worked, and when they got to obviously age 65, they were just entitled to obviously the age pension from the government. But the thing about it was only about half the male population lived to age 65. So we didn't live through to our 80s or 90s. And the average time spent in retirement was around about 11 years. Now, if we fast forward and the slide shows, say, in 2018, these statistics were obviously were brought together. It says here that the life expectancy of an average male, now it's around about age 80, 83. Okay. And then even females, their expected average age is around about age 85, 86 now. So when you get to age 67, which is the age pension age, we're actually expected to retire and live for, around about 18, 19, 20 years, which means that we need to go ahead and ensure that we've got enough money that's accumulated behind us in our super or outside our super to go ahead and maintain our lifestyle, which is there to go ahead and obviously supplement whatever you would receive from the government for the age pension when you get to age 67. So it's a lot different to what it was, say, 100 and, 100 and say nearly 110 years ago. So how much is required for a comfortable retirement? Research provided by the Australian Super Foundation Association, it shows that a comfortable retirement, a single person may require a lump sum of around about $545,000. And couples, they may require a lump sum of around about $640,000. So this is actually based on an average budget and living standards for those aged around age 65. And it also assumes that to live comfortably, a single person would spend around about nearly $46,500 per year, while couples for a comfortable retirement would spend around about nearly $65,500 per year. So let's have a look to see what a comfortable standard retirement looks like. So once again, for singles and couples there, you've got the amounts there per year. This is for a comfortable retirement. You've got your daily essentials, you've got all your standard housing rates, and living costs, groceries, transportation, whether it's through public transport or your car, and obviously the costs associated with running a vehicle or two, just standard clothing and footwear to take us through each year. Also, staying fit and healthy and moving, that requires obviously, appointments with a doctor, your health insurance, and also, being a member at a gym or at some sporting facility. And then you've got your social engagement as well, all the things that come to obviously you attending, having interactions with others, and enjoying the great outdoors. And then there's also connecting with your family. So, using your computer, your mobile, even travel, one domestic flight per year or even one international flight every single 7 years for that. Overseas trips. So look, it's quite it is a comfortable lifestyle. It's not bare minimum because it's got some added luxuries there, but you can just show that that's what a single person, also a couple will require in retirement based on that comfortable standard of living. For you to actually gauge what your comfortable standard of living is, AMP have also got another calculator which helps you determine what your retirement standard looks like. So you can go ahead and plug in what your expenditure is or would look like for you to determine roughly what you would require per year as either a single person or as a couple. And then you can look to see what your super is going to accumulate to based on your contributions going into it, your investments, and then to see whether that super fund is going to go ahead and meet your standard retirement living costs. So when we talk about growing your super, the thing about superannuation is you can't access it until a particular age, and that's called your preservation age. And, for myself, my preservation age to access my super is age 60, which would be for the majority of us as well. And the thing about that is that I know that my super contributions are contributed through my employer. I put in some contributions myself, and I can't touch that superannuation until age 60. So that means that I've got money going in and it's actually being invested, and I'm earning interest on top of interest, which is called compounding interest, which is a wonderful way to go ahead and accumulate your superannuation. Now, when we accumulate our super, we invest our money into an investment portfolio. So your money is invested, and it's invested by your super provider and also the investment managers behind the scenes, and they invest in asset classes. So they invest in different assets to get you minimum or maximum return. Now, depending on the sort of return, depends on how much risk you're taking within your super and within those assets and within that portfolio. So on the left there, you've got the return ladder, and then on the bottom, you've got the amount of risk that you're taking to get that return. So as we start at the most conservative or the most defensive asset class, that's called cash. So that's investing your money in a bank account. And that should give you an average return over, say a 10-year period of around about 0.5 to 1.5%. Cash rates have been quite low for quite some time and starting to increase at the moment. Then you've got government and corporate bonds. They can earn between 1 and up to 2.5%. So for taking a little bit extra risk, you're getting that slightly added return as well. So cash and bonds, they're called defensive investments. And then we move up the scale to more growth investments. So that would be investing in property. And these portfolios invest in commercial property, industrial property, the large, skyscrapers that are in major cities, they're usually owned by, the property trust within your superannuation. Then you've got equities, or also known as shares, which is you're a part owner of a company, whether it be Apple or whether it be Qantas or banks or any company within Australia or overseas. They are obviously a integral part of your portfolio. Now, property and equities or shares, they provide the growth element to your superannuation. So in essence, you've got defensive investments or assets, and also growth assets as well. And depending on what mix you have of either one of those, determines obviously your ability for your returns throughout your lifestyle or throughout your working life with your super. Now, with AMP, they've got default investment options, as a lot of super funds do. So as soon as you join the super fund, you put into their default investment portfolio. So how AMP's portfolios work, it's called a My Super option, and it's invested depending on your decade of birth. So you're either in the 2000s fund, the 90s fund, the 80s, 70s, 60s, 50s, or 40s fund. So if we look at this this chart here, you've got the allocation to growth assets on the left-hand side, and then also got your age at the very bottom. So if we look at the very bottom, we've got the age there. Say someone who's born, who's between 20 and say 35 years of age. You can see the pie chart there, which is your portfolio. It has around about 95% exposure to growth assets. So quite high risk, taking extreme and high levels of risk to get you higher return because it's got more money invested in property and shares. And then the other 5% is in defensive assets, such as cash and bonds. Now, these portfolios are designed to de-risk as you transition through your working life. So when you get to say your mid-40s, you'll start to de-risk out of growth assets. Not a lot, but still you might have about 90% of exposure to shares and property and only about 10% to cash and bonds. And then when you start to transition into your 50s, they'll pull back even further, say 70% exposure to growth assets. And then when you get to say 65, you've only got about 55% exposure to growth assets. Because with what happens with investing in these growth assets, such as property and shares, comes with volatility. So when we're actually close to retirement or in retirement, it's usually human nature that we don't like to take too much risk, but still invest your money enough where you've got exposure to growth assets where you're still going to earn a nice average return to obviously keep your accumulated superannuation balance buoyant, so it doesn't obviously drop away too quickly because you're drawing on the income from it. So you've got your portfolio. Now we look at, okay, well, how do I invest more money into superannuation? We are limited as to how much money can go into super per year. They're called your contribution caps. It's important to understand contribution caps because if you exceed these caps, you may have to pay extra tax. So at a concessional rate of tax, that's called a concessional contribution. That is employee contributions coming in from the casino food co-op. Like I said, they need to pay 10.5% of your gross income per year into super. When that money goes into your super account, it's taxed at a rate of 15%, and your super fund sends that tax off to the Australian Taxation Office. So employee contributions taxed at 15% is classed as a concessional contribution because it's taxed at a concessional rate of tax of only 15%. The other concessional contribution is salary sacrifice. So you're able to forego some of your income per year. You can tell payroll, I'd like to put in $1,000 per year from my fortnightly or monthly pay. When that money is put into superannuation, that's taxed also at a concessional rate of tax of 15%. So both employer contributions and also your salary sacrifice contributions are classed as concessional contributions, and whatever they equal, they can't exceed $27,500 per year. You can also make after-tax contributions. So money that's sitting in, say, a bank account, you've probably gone ahead and paid tax at your marginal tax rate and declared that to the ATO every single year when you do your tax return. So any money that's been taxed already and is sitting in your bank account, you can go ahead and make a contribution up to $110,000 per year. So let's look at your concessional contributions, which are your employer and salary sacrifice contributions. So that's when you salary sacrifice, you're directing some of your pre-tax income into super, which is there to boost your retirement savings. It's being a step ahead of I guess, everyone else who's only receiving employer contributions. Like I mentioned, you pay a 15% contributions tax when the money goes into your super. So that means 85 cents in every dollar is working for you within your super. The money is invested in the highly tax effective super environment because any interest earnings within your super each year based on your portfolio performance, that's taxed at 15% as well. Any earnings outside of super, they're taxed at your marginal tax rate. So for some people, that might be a little bit higher, but you can speak to us as to whether salary sacrifice is suitable for you. Here's an example. This is for the financial year 2021-2022. Let's say if someone's on a income of about $75,000, the total tax you would pay normally is about $16,342. So that's a tax rate of around about 21.76% tax. And you take home about $58,658. Let's move to the right-hand side where you've got the salary sacrifice scenario. You've got someone on an income of $75,000. Let's say that they decide to salary sacrifice $5,000 into your super. That means you're taking $70,000 as income. Tax on $70,000 is about $14,600. So that's a tax rate of around about 13.05%. And then you look at tax on super, which is $750 because you've paid 15% tax on that $5,000 contribution. So the total tax you pay is $15,367. Now the take-home pay, because you're only taking $70,000, has reduced. Your take-home pay has dropped to $55,383, but you've added $4,250 into your super. So the net benefit, when you look at the tax saving, is around about $1,000 because your net benefit there is $59,633 compared to $58,658. So it just shows you the benefit of what salary sacrificing has from a tax incentive position. How do you start salary sacrificing? Well, firstly, you calculate how much employee contributions will add up for the year. Think about how much you'd like to contribute from your salary through salary sacrifice. That can be through even bonuses or future leave entitlements. And then consider talking to us as well as to whether there's going to be a tax benefit for you based on obviously what your income is for the year and how much you're going to salary sacrifice. And if we decide that it's suitable for you, then you put an agreement in place with your employer in writing and ask them to go ahead and set up a salary sacrifice arrangement on every pay or throughout the year as well. Now, you can also contribute to super after tax. Like I said, that's called a non-concessional contribution because there's no real tax concession there. But that was putting in up to $110,000 per year. So you can contribute additional money into your super, and you might want to do that if you, say, receive an inheritance. You may sell an asset and you might have some money left over, or it might be a gift and you want to put that away into your superannuation as well. Like I said, your cap is $110,000 per year. You can also go ahead and claim a tax deduction on that contribution as well. So it moves from a non-concessional contribution to a concessional contribution. And then that fits in the $27,500 cap as well. Once again, speak to us. We can help look at the numbers for you and what's the most tax effective way to go ahead and make those contributions. So you can also go ahead and put your money into superannuation, but also there's a carry forward rule as well. Each year, your cap is $27,500 as a concessional contribution. Now, let's say in a year, you don't actually put in all of that amount. Let's say you put in $20,000 worth of concessional contributions. That means there's about $7,500 left over from the previous financial year that you can carry forward into the next financial year. So that's called the carry forward rule. Now, that applies to people who have a total super balance less than $500,000 on the 30th of June of the previous financial year. You have the 5-year carry forward rule. So that actually started back in July 2018. So you might be able to put in more than just the specified caps per year. There's also a work test that applies for people that are age 67 or older and wanting to carry forward as well. You can speak to us in relation to what that work test is and work out what's best for yourselves. There's a slide that's an example in relation to the carry forward rule, but like I said, any unused concessional contribution, you can actually carry forward to the next financial year. You also have a bring forward rule for non-concessional contributions. Like I said, you're allowed to make a concessional contribution up to $110,000 per year. If you don't use that, you can carry forward any unused into future years as well. The government actually allows you to go ahead and make a $330,000 one-off contribution. Someone might have sold a house. You can put that $330,000 in as an after-tax contribution, but you can't make any further after-tax contributions for another 3 years. So that's called a bring forward rule as well. Unfortunately, if you're over the age of 67, you are capped to just the $110,000. You can't bring that bring forward rule forward of $330,000. Government co-contributions, we've probably all heard about these. If you are earning less than, say, $57,016 per year, the government may top up your super up to $500 per year. The ruling is if you put in $1,000 of after-tax contribution, so money out of your bank account, which is about $20 per month. If you're earning under a particular threshold, you can just give us a call to ask what that is. If you put in that $1,000, the government will match that with $500 when you lodge your tax return as well. There's also spouse contributions. If you earn less than $40,000 per year, and your spouse may be able to receive a tax rebate by contributing into your super. The maximum contribution is, say, $3,000 after tax. If your spouse makes that into your superannuation and you're earning less than $40,000 per year, they may be eligible for a tax rebate at a maximum amount of $540 per year, which they use to take off of their tax liability per year. So just a little tip for those income earners as well. The fees that are associated to the Northern Co-op AMP Staff Super Fund, there's been some discount in fees over the last couple of years due to the simplification process that AMP has undertaken just to maintain competitive in the market. So some great competitive fees that have been forwarded on to members. The investment fee, so for you to invest into your My Super portfolio, depending if it's the 1960s, 70s, 80s, 90s, 2000s, the investment fee is 0.26% across the board. It was initially 0.3%, but they've obviously passed on a reduction there. The administration of your super, that cost is 0.29% per year, and and Northern Co-op members also pay a member fee per month of $6.50 per month. It was initially about 18 months, 2 years ago, around about $7.57, so that's been reduced. There's also an indirect cost ratio fee that differs depending on your cohort of where you're invested. So if we look at the total fees, you're paying $78 per year, which is the member fee. And then for someone that's, say, in the My Super 1960s option, you pay 0.87%. So the cost for someone who has, say, $50,000 in your account, you can see there that it's around about $513, which is a little bit less than what it was based on those discounted fee reductions that have been passed forward over the last, say, 18 months. So when you first join as a member of the Northern Co-op AMP Staff Super Fund, you receive automatic life insurance as well. So that's death insurance or death cover, and also TPD, which is total and permanent disability insurance. And to go ahead and understand or work out how much you receive, all employees receive a level of cover which is age-based, and it's 2 times whatever your age base unit limit is. So for someone at the age of, say, 50, if you're joining the fund, the amount there is $14,000. Just times that by 2 because you receive 2 times that cover. So you'd receive $28,000 of death cover and total and permanent disability insurance, which would be used if either of those unforeseen events was to occur. Now, the cost for that cover is actually deducted out of your superannuation. You don't have to pay for that from money from outside. You also receive as a default level of cover this is for full-time and part-time employees, unfortunately not available for casuals. You receive salary continuance insurance as well. And that's if you're sick or injured, unable to work, and a doctor prescribes or a specialist prescribes that you're unable to work, and you're not able to work for a period of 90 days, that's called your waiting period, the insurance company will go ahead and pay you 75% of your gross income. And that pays you for a time frame of up to 2 years. Once again, the premiums for this insurance cover is paid by yourself, the member. While we're talking about insurances, look, it's important to talk about, in the event of your death, what happens to your super? What happens to your death insurance as well? Well, we ask you to treat this with care, but also to take action to go ahead and nominate a beneficiary. A beneficiary nomination pretty much specifies who you'd like your super and your death cover to go to in the event of your death. Who can you nominate? On the left-hand side there, you've got your spouse, which is including a de facto spouse relationship, same-sex relationship as well, your children, a financial dependent, someone who's financially dependent on you, that you're helping with financial needs. It could be also, if you don't have a financial dependent, a legal representative, or leaving it to your estate, which means you'd need to have a will put in place. And also you can leave it to someone who you have an interdependent relationship with as well. So regardless of who your super provider is with or who your super is with, please check to see who your beneficiary is. If your relationship status circumstances change, also be sure and be diligent to go ahead and change that to ensure that the money ends up in the right hands. So just finalising, if you're wanting to learn more, look, all providers, you can access your details online, but AMP, they have the My AMP app, which goes ahead and shows you how much insurance you have, the balance of your super, where you're invested, and also who your beneficiary nomination is. So download the app and you can then access your details of your super on a daily basis. There's also financial wellness that's available. They've got financial wellness programs at AMP. They've got support. Also, there's even podcasts available. And also there's complimentary phone-based advice by contacting us as well here at Advice First. So if you've got any queries, call us and then we'll go ahead and direct your call based on what your need is. They've also got a group of webinars that are available. So you can go to the AMP website there, and they talk about understanding your super, giving you market and economic updates, getting you ready for retirement, even women with super, helping you with accumulation of your super balance if you're made redundant, or recent, also getting you on track with your superannuation. There's a lot of information and some easy to understand webinars available for you if you're wanting to improve your financial literacy in relation to super. Finally, with ourselves at Advice First, we're available on Facebook, LinkedIn, and Instagram. They're our social media platforms. There are our addresses there for you to actually access us, like us, and also you'll then start to receive articles of valuable financial information, which is information based on things even outside of the scope of superannuation, which is creating wealth, protecting yourself via insurances, retirement planning, borrowing money as well, wills, estate planning, and also any tax implications as well. So we've also got every single week, a couple of times per week, some articles of great information that you can share, also just to read, share with your family or to read to go ahead and increase your level of knowledge. Finally, these are our contact details at Advice First. It's a service available to members and employees of Northern Co-op Meat Company or the Casino Food Co-op. We've got Kim, she's the administration manager. Give her a call direct for any queries. There's myself. There's also a barcode there as well, which the QR code, is for you to book a one-on-one. So if you'd like to have a one-on-one with us, feel free to jump on that and we'll actually reach out to you to book in a suitable one-on-one to address your needs. And we've also got Lisa Forbes there. She's a partner of the business, but she's our home loan specialist. So if you're in the market for a home loan, wanting a review of your existing arrangements, she's phenomenal. Give her a call, reach out, and she'll be able to go ahead and run a complimentary review for you as well. Then there's the contact for AMP. So look, that takes us to the conclusion of the webinar today. Thank you for tuning in. If you've got any questions, if you'd like a one-on-one, feel free to reach out to us. We're available for you and your family. Thanks again and enjoy the rest of your week. Bye.